Okay, let's dive right into this explainer. The main reason we're putting this together today is because we're seeing a massive wave of affluent Indian investors, alongside other global wealth, looking to secure premium property in Dubai. If you follow global real estate at all, you already know Dubai has been on an absolute tear since the pandemic. But if we look ahead to the 2026 to 2029 horizon, we are seeing a profound, really fascinating structural transition. Basically, the wild, aggressive expansion phase is over, and we're officially entering a highly sophisticated, yield-driven maturity phase. It's a huge shift, so let's unpack the data and figure out exactly what this means for your capital.
So here's our roadmap for today. First, we'll cover the macro market transition. Second, we'll pinpoint specific infrastructure-backed growth pockets. Third, we'll look at yield-optimized mature hubs. Fourth, we'll break down a major supply-demand decoupling happening right now. And finally, we'll tie it all together into a strategic portfolio allocation. By the end of this, you are going to have a completely data-driven mental model for deploying capital over the next 12 to 36 months.
All right, let's jump straight into Section 1, the macro market transition. We're moving from speculation to structured stabilization. Get a load of this number. Total real estate activity just hit a record 252 billion dirhams in the opening months of 2026 alone. That is a massive 31% year-on-year jump in transaction value. But what's truly interesting here, and what signals maturity, is that average citywide prices per square foot are actually stabilizing at a median of 1,770 dirhams. So we're seeing this really healthy price normalization happening right alongside robust, record-breaking volume. And here is the real kicker, the metric that explains that massive volume: 86%. That is the percentage of residential transactions driven entirely by cash buyers. Think about that for a second. When the vast majority of your market is unleveraged, you create this incredibly heavy insulation layer against global credit volatility and interest rate shocks. It's a remarkably resilient foundation. And you can clearly see the overall maturity curve we're riding right now. The steep, aggressive capital expansion we saw in 2024 and 2025 has naturally led right into the structured stabilization phase for 2026 and beyond. This completely proves the narrative has shifted. We're moving away from broad, throw a dart at a map geographic speculation and moving toward hyper-targeted, catalyst-driven asset selection. Which brings us perfectly to Section 2, infrastructure-backed growth pockets. This is all about capitalizing on mega projects. Our first high-growth pocket is Dubai South. This area is undergoing an unbelievable expansion driven by Al Maktoum International Airport, which is slated to become the world's largest. This isn't just a transport hub. It's generating a permanent employment base and integrating directly with the Jebel Ali logistics corridor. This specific catalyst is driving a staggering 60% historical area compound annual growth rate. In fact, they captured over 2,000 sales in just the first 10 weeks of 2026 alone. Next up, moving to the ultra-luxury frontier, we have to talk about Palm Jebel Ali. This is Dubai's most ambitious coastal expansion, literally twice the size of the original Palm Jumeirah. What makes this so fascinating is the entry point. You're looking at starting prices of 18.7 million dirhams for a 5-bedroom beachfront villa. And because every single unit easily clears the 2 million dirham threshold, buyers instantly qualify for the UAE's 10-year golden visa. Needless to say, it's drawing some serious global wealth looking for asset preservation. But here is why this is such an incredible play. It's the arbitrage gap. Right now, you have the established Palm Jumeirah trading at over 6,600 dirhams per square foot. Meanwhile, Palm Jebel Ali is entering the market at roughly 2,600 to 2,700 dirhams. That is a massive 60% structural price discount compared to its physically saturated neighbor. This gap essentially locks in an incredible 50% to 70% appreciation potential by the time handovers start rolling out in October 2029. Moving inland a bit, our third growth pocket is the Dubai Land Residence Complex, or DLRC. This is a brilliant mid-market transit play. The new 18 billion dirham Metro Blue Line is currently under construction. And get this, it has already triggered a 43% pre-rail surge in studio rents. Why? Because DLRC is sandwiched right between two future stations servicing Academic City. You've got 27,000 car-dependent students and faculty eagerly awaiting new transit hubs. And historical data tells us that maximum capital appreciation happens between the 10% and 50% construction milestones, which is exactly where we're sitting right now. All right, moving to Section 3, yield-optimized mature hubs. This is where we talk cash flow dominance. When we talk about yield in Dubai, Jumeirah Village Circle, or JVC, is literally the gold standard. It's home to over 85,000 residents and really leverages its mature, established infrastructure to drive incredible tenant retention. We are talking massive 95% to 97% occupancy rates across the board, pushing gross yields that consistently hover between 7.2% and 8.8%. Now let's look at the hidden killer of ROI, service charge friction. These are the operational costs that quietly eat away at your profits. When we model this out, it is eye-opening. Look at premium districts like downtown Dubai, punishing service charges of around 35 dirhams per square foot. Compress your actual net yield down to around 4.2%. In stark contrast, mid-market assets in JBC boast a much leaner 13 dirhams per square foot fee, which preserves a really robust institutional-grade 7% net margin. Right next door is Arjan, which offers a genuinely brilliant hybrid yield play. It's currently trading at roughly 1,355 dirhams per square foot. That's a huge 31% discount compared to Dubai Hills Estate, which is sitting right across the highway. But beyond just being cheaper, Arjan captures these super lucrative 8% to 9% yields from short-term holiday renters. They get massive tourist spillover from the nearby Miracle Garden and its 1.5 million annual visitors. It is a fantastic engine for immediate cash flow.
Okay, Section 4. To really protect those yields, we have to look at the supply-demand decoupling between villas and apartments.
Just look at this divergence in the primary market data. It exposes a severe market decoupling. High-density off-plan apartments experienced a very modest 3.1% growth year-on-year. Meanwhile, off-plan villas, which are heavily supply-constrained, surged by a staggering 35.3%. That is a night-and-day difference in asset performance. So why the massive gap? Well, there are roughly 366,000 units projected to enter the market by 2028, and the vast majority of those are high-density apartments. That creates an elevated pipeline risk for that specific sector. Seeing this, wealthy end users and long-term expat families are basically fleeing to low-density master communities. And because the available land for low-density builds is severely limited, villas have effectively become your premium defensive shelter for capital against any potential oversupply. All right. Final section. Let's take all this micro and macro data and build a strategic portfolio allocation for the next 12 to 36 months. The optimal deployment model pointing out from the data is what we call the dual engine strategy. It's pretty straightforward. You dedicate 60% of your portfolio to a high-yield mid-market cash flow sleeve. These are stable, ready properties that lock in predictable, immediate income. The remaining 40% is your growth cap, strictly positioned in those infrastructure-backed, off-plan equities we discussed, designed specifically for future capital appreciation. So in the real world, here is exactly what that looks like. For your 60% sleeve, you yield stack secondary near-completion units in low-service fee areas like JVC and Arjan, firmly locking in that 7% net yield floor. Then, you take your 40% growth cap and establish early equity stakes in off-plan villas down in Dubai South and Palm Jebel Ali, or maybe grab some transit corridor apartments in DLRC. This dual-engine approach safely balances highly stable monthly income with absolutely tremendous terminal capital gains. So I want to leave you with this provocative thought to evaluate your own capital exposure. Are you still trying to broadly speculate, hoping a rising tide lifts all boats? Or are you executing a structured dual-engine strategy? Because the data makes it incredibly clear. The era of blind speculation in Dubai is officially over. The market has matured, and your portfolio allocation absolutely must mature with it. Thank you so much for joining me for this explainer, and I really hope this framework helps you navigate your investments in the exciting years ahead.